Good day to our viewers. This is Leon Greyling of EBnet Stream, and you're joining us today for the second episode in our series, Living Markets with Liberty Corporate Benefits. I'd like to welcome again my partner in crime on this series, which is John Taylor, an actuary and investment expert from Liberty Corporate Benefits. John, welcome.
Hey, great to be with you again, Leon.
Good. I hope you have been keeping a close eye on the markets over the last month.
It's been a roller coaster, absolutely.
Yeah, that's for sure. So I've seen lots of ups and downs, but at the end of the day, we've just ended higher, another over 3%
Yep.
on the all share over this past month. I mean, how long can this possibly continue?
I've been having some chats with a couple of colleagues over the last couple of days and saying that the higher both the global and the local markets get, I think it is cause for everybody to have a look and take a bit of a breather and say, at what point do you have to start being a bit anxious about introducing particularly large lump sums of capital into this kind of market?
But you say that, yet the fund managers on average still remain, I think, fairly, I don't know if bullish is the right term, but almost optimistic rather.
Yeah.
But whether that's a case of they don't know where else to go, that's really the question mark I have. And I have seen a few fund managers in South Africa starting to get a bit more conservative. And it reminds me a little bit of the mid to late 90s, where a couple of the bigger guys became very conservative off the back of valuations and the small cap bubble that took place. One of which was Liberty Asset Management, LIBAM, as it was known then, which actually survived it. But the other ones were Alan Gray, who, believe it or not, nearly shut doors off the back of loss of clients because their performance lagged. UAL was another one that didn't last. SCMB was another one. These were big fund managers back then in the top 10, and they took a conservative slant, and many of them felt the brunt thereof.
Absolutely. I think what you're pointing out as you go through a list of managers that were and how the landscape changes, is just how difficult it is to pick next month's, next quarter, next year's winner, in these kinds of markets and in any kind of market, because the landscape changes so materially all the time.
And you spoke last time in our conversation. You gave the sage old advice, and we can call it sage. I'm gonna call it a bit boring. So stick to your knitting.
Yeah.
As a pension fund in particular, but even I suppose as any individual, make sure your plan is right and
Yep.
stick to your plan, because none of us can call markets.
Yep.
So does that still ring true to you?
Leon, I'm going to be boring then, and I'm going to say yes. I think given just the time horizons that as individuals often, and definitely as retirement funds we're dealing with, it demands the fact that we actually do need to be cognizant of market conditions. As I said, if you are looking at transitioning and you're looking at introducing large amounts of money, then absolutely think a little bit about that. But if you are continuing to save for retirement that is 10, 20, 30, 40 years away for you, the rules of the game haven't changed.
So I've got an article that I wrote for Pensions World. You also have an article in Pensions World Q3 this year. So I recommend to viewers that they go read your article and also read the one that I have under financial planning regarding the behavior gap. Ultimately, the biggest risk is ourselves when it comes to investing, because we make decisions really at the right time, if I could put it that way, because those decisions are driven off the back of emotions and psychology. And the reality is there's not a single person, even the best fund manager in the world, that doesn't feel the emotion of fear or greed when ultimately investing. So right now we're sitting in a situation where shares are hitting new highs, and it continues to go. It's awfully tempting to want to climb in and experience the same that others might be experiencing. All of our mates at the golf course or around the bar saying, "Oh, I made so much on this and I made so much on that," and now it's tempting in that regard. And then as soon as things go wrong, it's in the case of panic and get the hell out of there, which often is not the right time. Do you think it's possible for investors to avoid that psychological emotion or bias when it comes to investing, and how?
Leon, I think we all fall prey to it. I think the trick is to build in frameworks and kind of safeguards that prevent us from individually making those kinds of decisions too hastily. Um, I think it takes me back to a well-known phrase which says the first rule of investing is don't panic, and then the second rule is if you're going to panic, be the first person to panic. And very seldom can we be the first one to sell out at the point where it's time to. So it does point to the fact that we need to have safeguards in place, good advice, good consultants, and stick to our knitting. Keep that long term in mind. Stick to those very boring asset liability matching frameworks that often our consultants are talking to us about, to make sure that we aren't making knee jerk reactions. I mean, I have a client who knee-jerked in March 2020. Markets had tumbled 15-20%, said, I'm selling to cash. First big mistake. But the even more difficult one is it's taken us the last 5 years to get them back to a point where they can get back into the market because they sold and they were not quick enough to get back in. And the market kept running up and up, but we kept on saying, is it the time? Is it the time? If they had have simply ridden the wave, we wouldn't have had to even had that conversation in 2020. So uh, I think we must be very cautious about trying to time that market, because it's so difficult. You might time it right out, but to get back in is very, very difficult to do.
So answer this for me. We've got the tradition in South Africa of balanced mandates, as they're known. So where your asset manager or asset managers, they themselves are timing the markets around some kind of a benchmark, mostly peer related, where they're cognizant of each other and then will tweak up or down accordingly, kind of thing. So there often trustees may have the expectation that the manager should be able to make that call in terms of the timing. Then you have fixed asset allocation models where you're basically rebalancing back to that allocation on, be it a monthly, quarterly, or however often basis. What are the pros and cons of the two? And is there any, do you favor either approach in your advice?
So for me, if you had to ask me to pick a side, I favor sticking fairly close to your knitting. Your strategic asset allocation, it's been proven. The variance in returns driven by it is over 90%, and that's been the case since the Princeton Hood study was done in the 90s. I don't think there's any evidence to the contrary. What that means is that at the end of the day, you need to focus 90% of your effort, your governance budget, all of that into getting your right strategic asset allocation. Tactically shifting and saying, I want a little bit more in equities, a little bit more in bonds, a little bit more in resources, a little bit less in financials, that's on the margins. And some managers have been able to prove that they can do so quite successfully over longer periods of time. And as we said, there are going to be years that their styles in favor and years that it's not. What for me is critical is kind of limiting your tracking errors, sticking close to that knitting, and as long as you have a manager who acknowledges that they're going to stick close to their knitting and they're not charging you fees as though they're going to swing for the fences, but then they're going to deliver close to benchmark kind of performance, then you probably are doing the right thing.
So I'm a member and I have a look at my in fact, this is the worst possible scenario I can give you because I am a member and I don't do this, which is look at my benefit statement a year ago. If I'm looking at it now again, I'm probably 20-25% up given contributions and given market returns. So I'm thinking happy days. These trustees are heroes. Well done, guys. Good job. At some point in time, though, I've still got 15 years to retirement. Within those 15 years, I'm going to pick up that statement, and it's going to show a decline, and possibly a quite significant decline given the valuations that we're reaching. Now, from my perspective, it's only natural to show anxiety
Yeah.
at that time. So when you talk about frameworks, it's all good and well for trustees to have those frameworks to help them overcome the emotions. But how do you take that one step further now in terms of I'm a member? I've been used to seeing these really positive results. Now, all of a sudden, at some point in time, I'm going to see the opposite thereof, and I'm going to immediately have anxiety around it.
Yeah. And we've gone through that. I mean, I think we've all seen times where markets go backwards, and you get time periods where the benefit statements to a member will show that the value has reduced, and that can even be in nominal terms. Forget about the effect of inflation on that. Um, I guess in some ways, something like a two-pot is useful because it at least make sure that members don't just pool money. At least two-thirds of it will remain invested and go through cycles. The trick is to keep them from de-risking into, as we said, trying to time that market sell out at the low because they're now fearful. Um, on the other hand, it becomes so important that in our industry, we emphasize the other ways of looking at that retirement fund. Um, and in the conversion from defined benefit funds to defined contribution funds, which I mean happened a long time ago now, by and large, we lost a bit of the essence of what the retirement fund was for, because that focus on that share of fund, that capital value, that if I resign, I get that much money out, became all overriding. That was like the only thing in the benefit statement that people were looking for. And we need to get back to emphasizing and saying you are on track to retire with some way of linking it back to the living expenses that that member has. And I know we've spoken about things like net replacement ratios and red, amber, green, and you're on track and this is it. But I think there's no more powerful way of me being able to say, if you used to taking home 30,000 Rand a month, and I tell you, you on this road, you only are likely to take home 15,000 Rand a month, that becomes a number you can play with. That becomes a number, it's better than saying 50%, because 50% either completely turns you off and says it's impossible, or even a lower number than 50%, or it's just not easily relatable. But if I told you you're used to getting 30,000 Rand, you can only expect 15, can you make it all fit in that? That becomes real bread and butter for people, I think.
So, but who does that? I haven't seen that unless I'm a little bit out of date, if I could put it that way. I'm used to seeing the 60%, 50%, but again, that's so
Yeah,
intangible. So if
it's
someone says to me, listen, you earn 5 Rand and you're going to have to live off 2.5, whoa, I need to
yeah.
do something.
Yeah, I don't think anyone is really doing it to the level that we need to get it to. And I'm hoping that with the flurry of changes we've seen with the tea days and the two pots and all of these things in our industry over the last couple of years, we do see a few of the administrators and insurers starting to uh, think down to that level where you can really tie it back to say you are in current money. If you were earning, as I said, 20,000, 30,000, now you're only going to get 10, 15, whatever the number is. That becomes a very tangible way of saying, can you fit your budget into that Rand value?
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
The the US markets right now, the tech stocks continue to perform, most of them.
Yep.
Right. And it's a bit of a catch-22 because people say, whoa, big tech bubble looming again, like the dot-com bubble. Yet AI is booming. The continued innovation on the tech front is just driving things. So these companies, while they're trading at very high price earnings multiples, indicating whether they're expensive or not, it's not taking into account the future expected earnings that will come through from these companies. So I sit as an investor in tech in the US, and I think, should I or shouldn't I be? Given those valuations. Do you have any comment around that, or is it what's expected, and how do you deal with that catch-22 situation?
Yeah, Leon, at least you're aware of it. I think even for those that think I'm not directly exposed to tech in the US, I'm just invested into a MSCI World Tracker. And then you point out actually the top 10 shares in the world are 25% of that tracker now, which is a concentration we've never seen before. And as you rightfully point out, 7 of those 10 shares are the Magnificent Seven, those big tech shares. I think it's a risk that a lot of people are unaware that they're actually facing, and at the same time, it's impossible to say this time is different because many great investment theses have gone south on the basis of that kind of thinking. What is important to say is, the tech story is real, and we did have a dot-com bubble, and the companies that are still around from there have continued to grow, and the companies that have not fared that well are also, either there or have been absorbed into other things. So if you think back to the big tech bubble, the dot-com bubble that we had 20 odd years ago, the companies like an Intel and a Cisco and an Adobe, those guys are still around. Some of them have grown a lot. Some of them have really not done as well as they should have. But companies like a Microsoft, they went through a period of being a bit on the periphery, but they've come back with a vengeance. So I think it's important to keep the diversification theme in mind. Not all tech is the same, is another important point. There's a big difference between a Tesla and an Apple and an Amazon, even though at the end of the day, they all are tech stocks.
So Federal Reserves around the world are all loading up on gold. Should that make me worry that they're going so prudently forward?
This was another important topic I had a good debate on last week. We haven't seen gold do anything for 20 years, and then you've had 2-3 years now on the trot of gold just shooting the lights out. You've seen incredible dollar weakness come through, and I think we spoke about it last time that a lot of people say the rand has strengthened. The rand hasn't strengthened. You look at the other currency pairs and it hasn't. It's really actually the dollar that's weakened, which is what President Trump and his administration are after, and one of the things that they actually have succeeded in getting that they wanted. I guess you do have to at some stage say, where do things take a breather? The same kind of applies to Bitcoin, and I'm sure we'll talk a bit about crypto soon. But at the end of the day, I do have a look and say, how much weaker can the dollar get? And in the face of potential, inflation creeping back into the system, I don't think it's as under control as it was 12 months ago. That does then ask questions around interest rates again. So I know that we're expecting rates to start creeping downwards in the US in the next couple of months, but I don't see a sustained cutting cycle that we might have hoped for.
And that's going to hurt us as well in terms of potential to cut rates further.
Exactly right, yeah.
So you mentioned it, so you've opened the door. Bitcoin, crypto. Federal Reserves are even talking about building up reserves in crypto. What is happening at the moment? The totally, I don't want to say misunderstood, but not understood asset opportunity or class or investment opportunity is suddenly becoming more mainstream in our lives in different ways. What is changing right now?
I think it's a case that when you don't know what else to do, you have to start looking a little bit out of your comfort zone. And crypto's been around, I think, just long enough that it isn't feeling so out of the comfort zone. $108,000 a Bitcoin, and as we sit here right now, incredible run. And one could argue, is it also time for a breather? In the same way that we spoke about gold. It's strange for me to actually think of gold and crypto in the same way, but that's what it's become. It has become a bit of a safe haven type asset. I guess there's still a lot of stigma around Bitcoin, or crypto in general, should I say, that is going to need to be overcome before it becomes a truly vanilla asset class. I think that's why it is a little bit of a way away from, for example, South African retirement funds being able to access it directly. But I think I'm certainly changing my tune where I thought it was almost never going to be to in the coming couple of years, we'll see it enter our retirement funds in some shape or size.
But I suppose at the end of the day, it comes down to the same economics. It's about supply and demand.
Yep.
So the price of the crypto is increasing, and it goes up, drops a bit, levels off, plays a little heartbeat for a while, and then tends to run again. And it's all based off the buying of the crypto. So
Yep.
more and more retail use of cryptocurrencies, more and more governments starting to buy in as a safe haven, more and more individuals investing in it. And that's what's driving. And if you think about it, it's come off effectively a zero base.
Yeah.
And it's now becoming more acceptable. So the upside is quite significant. Where that upside gets to, I've heard people talk about a million US dollars. I mean, that sounds incredible, but the reality is there is plenty upside. I mean, Bitcoin got up to, was it 140,000 or 135,000, somewhere around there as well. So the potential is still there, and I think people are seeing that, but it is a supply demand thing at the end of the day, no different to any other type of investment.
Exactly. And I think, Leon, that's where considering it as a crypto asset becomes useful compared to cryptocurrency. I think any currency that is as volatile as we've seen a lot of these cryptos be is very difficult to trade in. So to get it right that it becomes a unit of exchange, that's difficult for me to see right now. But as a store of wealth in some way or another, that the use case is becoming a bit clearer there, but acknowledging it isn't a substitute for cash or even necessarily like a gold or other kind of metal. So yeah, not 100% sold on the story yet, but certainly more open to that discussion than I would have been 5 years ago.
Okay. So I just got back from Cape Town and I attended the Institute of Retirement Funds conference. And I must be careful how I put this, and I don't mean to be derogatory, but the new bandwagon is impact.
Yes.
Everyone was talking impact. Now, I love the concept of impact because it's so important to me in the South African context because of our past and what we need to overcome and to build the right infrastructure that supports our entire population. Now, everyone's talking about it. Everyone suddenly is becoming impact in nature. Everyone's putting out sustainability reports and all these wonderful things that it's quite easy to start playing the violin and falling in love with each other over. But how real is it at the end of the day? You sit as an investment consultant researching fund managers and trying to separate the men from the boys kind of thing in that regard. So what are you seeing happening on that front, and ultimately how real do you think this is?
Leon, for me, impact in some ways has been around with different names and different guises for some time. And if as a board of trustees and as an asset manager, you've been thinking about call it almost non-financial returns, or kind of the way in which you're measuring the outcomes that are coming from investing. That means you've been thinking about impact investing for way before even the three-letter acronym ESG came around, or impact itself. And I think it's important that we have those conversations so that we can differentiate between what it means to consider ESG or impact or socially responsible, because all of these things are nuanced and different. I think it remains to be seen how long kind of the in-depth kind of reporting part of this hangs around, and how those metrics evolve, because I think there's been a lot of work done to try and standardize and get us to talk a common language, and that's a really important piece of work there. What's going to matter is then translating that into the actual benefits to the members in the funds at the end of the day, and why, as I said, we've been doing this in a way, maybe not documenting it as well as we should, for some time, and that's going to be the true test of whether we can keep this ball rolling. But a really important conversation, and one that we need to continue to have.
Yeah, I'd like to actually unpack that a little bit more in our next chat and talk about ESG and what that really is and how that can lend towards impact and how we can make impact practical from a retirement fund investment perspective, because at the end of the day, private capital is retirement fund capital is a very significant part of our economy, and without some exposure or some investment into grassroots development outside of, call it, the almost philanthropic way of thinking, is necessary for us to overcome some of the challenges that we face. I think it's worthwhile unpacking that a little bit with a view to hopefully allowing trustees or any investor to view it from the perspective of opportunity rather than any kind of preconceived fear that they might have around things like this that they don't always fully understand. And the same thing, just very quickly, is what is your view on private markets for a pension fund? Is that something that you see as an opportunity for your customers?
Spot on. I was about to say the way in which most pension funds are able to dip their toes and get used to this is through looking into private markets, and various instruments of different phases and so-called vintages of the existence are there. So you don't have to buy into, right at the very beginning. You can dip your toes into an investment that very much looks and smells like a listed instrument. It's just not listed, but you have all the metrics there and a lot more certainty, and you can gradually get used to all the different ways in which these are financed, and at, as I said, different vintages, different ages into their life cycle. So very much something that I encourage funds, institutional investors of all shapes and sizes to have a look at. And it isn't just for the mega funds anymore. You don't have to have 10 billion in assets before you can start to look at this kind of stuff. You can very much start to look at this from a much smaller size, because there are various partnerships and structures and private equity and private debt structures that you can look into infrastructure. So the ways in which we can facilitate liquidity, because ultimately that's what everyone's scared of here, is liquidity. When I need that money, I can't sell because it's not listed. There are ways in which you can facilitate that in a marketable, liquid way.
Okay, well, I look forward to unpacking that with you, because also a strong, healthy private markets industry in South Africa lends towards the public markets, which lends towards more investment opportunity in the future. And for trustees, they always say to me, our biggest risk or responsibility is to make sure members retire comfortably, which I agree with, but you need to make sure they retire comfortably into the right kind of environments where they can enjoy that. But also, your members might only be retiring, at least some of them, in 50 years' time.
Yeah.
So, you've got to grow those opportunities so that for their pot to continue to grow 40 years from now, kind of thing. Yeah. So if you don't look forward, you might be failing in exactly that endeavor that you set out.
That's it. What kind of world are we expecting our members to retire into and provide money to the dependents to, if we aren't considering the environment, to the social, the governance factors? As you say, return at what cost, kind of.
Yeah. So look into your crystal ball, John. I know it's there. Liberty must have a crystal ball somewhere. The markets are up another nearly 0.5% today. Where are we going?
Yeah, I think, Leon, at the risk of making bold calls that you're going to call me out on in a month's time, it's hard to see the train necessarily just stopping right here, and this is where it all stops. I would be cautious every time it clicks upwards. One does need to take stock and say, those price to book, price earnings valuations, all of those are getting a little bit heftier, even in the South African space, which I haven't had to worry about for quite a while. It's fantastic that we're seeing some positive and double-digit equity returns in South Africa. We didn't see it for like 10 years, from 2012 to kind of 2020, 2021. It is eye-watering. So I would caution anybody who thinks that another 20% years ahead of us. That to me sounds unlikely, and I might eat my words in 12 months' time. But yeah, I think enjoy the fact that we're hitting the CPI targets that everyone is hoping and expecting to, but don't get too comfortable at the kind of 20-25% return levels that we've been seeing.
So I'll congratulate you for successfully dodging the question about giving substance around the dodge, and the only thing I can say is it's 99% certain you will be wrong.
Yep.
So,
Yep, exactly right.
yeah. So, John, I look forward to chatting further in a month's time again and unpacking a bit around private markets impact and so on. I think it's a very important theme, and I hope that in the course of our conversations we never need to talk about a market fall or collapse, but I sense that perhaps we will at
It's
some
possible.
point in time before we are too much older. So anyway, it'll be interesting to see where we get to, but I think your sage advice, albeit boring, of sticking to your knitting, make sure you have the right framework in place and so on, I think is the only possible way of living markets at the end of the day. So I think it's very important that we leave the audience with that.
Yep, absolutely right. Thanks, Leon.
Okay, John, we'll see you next time. Thanks for joining us. And this is Leon Greyling from EBnet Stream, and that was John Taylor from Liberty Corporate Benefits. Till next time.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.